Cool. Let's get more on what's in store for markets with Jim Bianco, Bianco Research President. Jim, welcome. One of the reasons we love having you on, and I, over the years, have enjoyed talking to you, is that you often say the unexpected. A lot of sort of contrarian views come out, and today will be no exception. You expect 0 rate cuts this year. Explain your reasoning.
Well, I think they should have 0 rate cuts this year, but I suspect that the Fed won't listen to that and probably might cut. But the reason I suspect that we're going to have 0 rate cuts is I don't think they're warranted. The economy is continuing to move along just fine. It was growing well above what we call potential, or about 2.5% last year. It's growing a little bit below potential this year. That's what economies do. I suspect there'll be a second half rebound. And as far as the inflation numbers go, I've long been in the camp that the new level for inflation is 3 to 4%. We hit 3% in June of last year, 12 months ago. We then went up to 3.5% until January of this year. Now we're back down to 3%. So I'm looking at this as the lower end of the range. If that's all the case, then the Fed's neutral rate, if you want to put it that way, is probably somewhere about 4% or a little bit above that. And that's not that controversial because the market is very close. There's various measures that guesstimate where the neutral rate is, around 4%. So in other words, the Fed, if they want to get off restrictive, has only got about 4 rate cuts that they have to do it. If they're going to do 2 of them this year, they're effectively going to be at neutral by the end of the year. And given the strength of the economy, I don't think it's warranted. Now that I've said that, looks like what I think doesn't matter. The Fed's going to probably do it anyway in September.
Well, the wholesale prices were a little higher than expected. I mean, so inflation is it's not done yet, right, Jim?
Yeah, no, I don't think it is quite done. And I think really what you've got to look at in terms of inflation is a couple of things. One, the government spending. Government is 22% of GDP. There's only been 2 times it's been higher than that in American history. And that was the COVID response 4 years ago in World War II. That type of level of spending right there, you can't have a recession with the government spending that kind of money. And with the government sucking up that kind of goods and services with that kind of spending, will keep up pressure on keep pressure on inflation, which should keep pressure on interest rates. The other one is there seems to be a bit of a change in the attitude among consumers. Mm-hmm. They're a lot willing to consume and spend a lot more. I'm talking about per unit, not just because prices have cumulatively higher. And I'll give you one anecdote. Look at the numbers of throughput through the airports at 3.1 million, a new all-time record right now. And the reason I point that out is travel is the ultimate thing that no one needs, but everybody wants. And if we're all wanting to go 3.1 million of us a day through the airport, doesn't sound like the consumer's ready to slow down anytime soon.
Well, I'm traveling tomorrow, so I'm going to leave earlier than I even thought. One of the other things I want to pick up on, Jim, my notes indicate that you think the 10-year Treasury yield could still get up to 5.5%. What is going to take it there?
Well, a couple of things. The target was 5 to 5.5, so that is the higher level. I'll point out that as late as last week, the 10-year Treasury was still at 4.50. So we've been in a period of higher volatility. And the last thing I'll point out is around April. I've had that target all year, 5.5. We did get the 4.75 in April. And right after that, I kind of said, I'll still stick with 5.5, but it's more of a low conviction call. Now that I've said all of that, I still think it's going to be that the economy is going to be okay. The economy is going to continue to move along at trend, 2.5%, if not higher, in the second half of the year. And if inflation doesn't go much below my 3% to 3.5% target, that all portends for higher interest rates and probably above that 4.75 in April that we saw. And that gets me very close to my 5%, the lower end of my 5.5%.
Well, quickly, a quick thought then. If the 10-year gets to 5% or above, to even 5.5%, the connection there between that and mortgage rates is pretty direct. That's gonna hurt housing, isn't it? That's going to send the mortgage rate up close to 8%.
Well, it depends on what the definition of hurt housing is. Housing prices are not being hurt. If you're a home owner, there's nothing wrong with this housing market because your price keeps going up. If you're a home buyer, then yes, that is going to be a problem. But that is housing. Housing is not the entire economy. It's a $30 trillion economy. Maybe 2 of it is residential housing. So the economy. So when you look at interest rates, you have to think about the broad measure of the economy. So yeah, the most interest rate sensitive sector, housing, will probably be hurt, but a lot of other sectors won't be, and that's why I think interest rates can go up and the economy can withstand it.